a topic that a lot of people just don't have enough knowledge about.
Hi guys, welcome back to my channel. My name is Diana. If you're new, welcome. On this channel, we talk about personal finance, personal development, and money related matters. So these are topics that interest you. Please consider subscribing. So today we are going to be talking about investing. And what I realized is that a lot of people don't know too much about investing. So on this topic, we're going to be talking about the different types of short-term investments and the different types of long-term investments. We're going to be talking about stocks. We're going to be talking about bonds. We're going to be talking about long-term investments like CDs, IRAs. So just keep on watching and you are going to enjoy today's content. So why would you want to start investing? Investing guards your money against a thing called inflation. And through the power of compounding interest, your money can really work for you. So I'm going to use a little analogy. Think of investing as a small snowball. When you first start, the snowball is very small, but as you're adding to that snowball consistently, your snowball is growing and eventually it becomes a big snowman. So investing is in the same manner. You start little, but eventually your money starts to grow. The reason why successful people are so successful is because they do one thing. They're consistent in everything that they do. So if you want to be successful financially, you have to be consistent in making good financial decisions. And if you are considering investing, you have to consider what type of investor are you? Are you a short-term investor or are you a long-term investor? And once you've decided the type of investor you are, that will ultimately decide the type of assets you acquire. So if you're a short-term investor, you're probably looking to park your money anywhere from 6 months to 2 years. And if you're a long-term investor, you're probably thinking about the future and just more so trying to maximize on the compound interest. So the first short-term investments are stocks. So stocks are buying a share of a company. So picking the right stocks ultimately depends on how well you believe in a company. So if a company struggles, their stock prices goes down. On the flip, if the company profits, their stock prices go up. So let's just take a second and think about all of our favorite companies and where we spend our money on a daily. And I'm going to use myself as an example. So some of the favorite companies that I use, I have a Netflix subscription. I own Apple products. I have an iPhone. I have a MacBook. I have earbuds. I love drinking Starbucks coffee. I have a Disney Plus subscription. Now, I purposefully mentioned all those companies because not only do I use their services daily, but I also own stocks in these companies because I truly believe in the value that these companies have. You can literally start investing if you had $100. So we're going to take Amazon, for example. It's about $100 a share right now. And that is significantly cheaper than your annual Amazon Prime membership, which is around $139 a year. Stocks, for example, like Facebook and Amazon, a couple years ago, they were around $200 a share. Now they're currently around $100 a share. And also, it is worth noting that even if you felt like a share of a company was too expensive, you could also get a fractional share, which is just a portion of that stock. So the next short-term investments are bonds. Bonds are essentially a loan to a company or a government. And the way that bonds work is that you buy the bond and there's a set maturity date. And within that set maturity date, you're paid a guaranteed interest. Now, a very popular bond that a lot of people were flocking to was a government bond called the I-Series bond. And in the month of October 2022, that bond was paying as high as 9.62% guaranteed interest for the next 6 months. So what that meant is that if you invested $1,000 into a government bond at a rate of 9.62%, essentially you would be earning $96.20 guaranteed interest. And also, because it's a government bond, you are guaranteed to get your money back after the maturity date. So the next short-term investment to park your money is called a money market. A money market involves purchasing short-term debt securities. And typically the way you would invest in a money market is that you can invest through a money market mutual fund, through treasury bills, or even through your local bank by opening up a money market account. And due to inflation and the cost of goods going up, a lot of banks are actually offering up to 3% for a money market. Money markets are like savings accounts. So you put your money in there, however, they just have stricter guidelines. With the money market, you have access to your money. The only difference is that there is a higher minimum that has to be maintained within the account. And it typically will range from a minimum of $5,000 up to $10,000 minimum in that account. And also there are monthly maintenance fees as well associated with the money market. You are also limited to 6 transfers and the amount of checks you can write within that money market. Well, you may be feeling like a money market has just way too many regulations for your liking. Well, another short-term investment you can consider that is just as similar as a money market is actually a high-yield savings account. So what is a high-yield savings account? A high-yield savings account typically is just another savings account. The only difference is that it has a higher percentage that you earn in interest. So high yield savings account right now, the current market value, they're going for about 3% compared to 0.03% of the traditional savings account. And again, a lot of these banks are offering this amount because they want your business. It is worth noting that with the high yield savings account, you don't have to maintain a minimum like you would with the money market, and you're not limited to the amount of transfers you can do in a month. Now we're going to be moving on to long-term investments. But before I move on, if you have not subscribed, please go ahead and subscribe. Hit that like button so that the algorithm knows that you are enjoying my content. So the first long-term investment is the traditional IRA, also known as your Employment Benefits Retirement Fund. It goes by a 401k or a 403b. So the traditional IRA is where you would put your pre-tax dollars and your money grows tax deferred. It's going to reduce your taxable income. And a great benefit is that it is tax deductible depending on your income level. There are some key limitations to mention. You do have a contribution limit. So if you're 50 years and younger, then you can only contribute up to a max of $6,000 a year. If you're 50 and older, then you can add an additional $1,000. So another limitation to the traditional IRA is that you cannot take your money out until you are 59 and a half years old. If you take your money younger than 59 and a half, you're going to be hit with income tax and an IRS 10% penalty. So the Roth IRA is very similar to the traditional IRA. The only difference is that you have no contribution limits and you're required to pay your taxes up front on your contribution. So another pro is that the Roth IRA does not have any age limits. So you can withdraw your money younger than age 59 and a half without worrying about the IRS hitting you with a penalty fee. So if you're asking yourself which IRA would be the best for you, maybe a traditional or a Roth IRA, the best question to consider is, what will your income look like at the age of retirement? If your income level is going to be significantly less at retirement age, so that means you're in a lesser bracket, then the traditional IRA would be best for you because you'd be paying less taxes at retirement. However, if you feel like you're going to make way more money at retirement, then the Roth IRA would be the best for you because you would have already paid all of your taxes up front. And to all of my self-employed people and small business owners, you can look into the STEP IRA. And that allows you to contribute up to 25% of your income towards retirement. So the final long-term investment option is a CD, which is a certificate of deposit. So similar to a savings account, the CD is an account that you open up where you put your money into it. And for a set amount of time, your money is actually going to build interest. Another pro is that the interest that you're earning in the CD is actually a lot higher than the high yield savings account or even the money market. Some CDs are going for as much as 5% based on how long you keep your money in that CD. So if you don't need your money for another 5 or 10 years, then a CD might be a great option for you. But if you're looking in the short term to maybe make a big purchase, such as buy a car or buy a house or maybe go on vacation, then the CD would not be the best option for you, because if you put your money inside of the CD and you touch the money before the maturity date, you actually get hit with the penalty fee. And just a note, guys, I am not a financial advisor. These informations are for educational purposes only. And if you haven't already subscribed to my channel, please go ahead and subscribe and drop in the comments section what investment options are you thinking about looking into. Thank you guys for watching this video. And if you haven't checked out my other videos, go ahead and do so. And I will see you in my next video.